Good morning, everyone. This is David Millington, your host and Director of Education at Next Level Purchasing Association for today's webinar on Savings Strategy Development, Webinar 1 of a 4-part webinar series. Thank you, everyone, for joining me today, and I hope that you have an awesome experience. We're going to cover significant content that I'm sure and I trust that you will be able to incorporate into your day-to-day purchasing functions. So it is very important that all of our activities are underpinned by, and you'll hear me say this a lot and refer to this a lot, the mandate, the core mandate of the procurement function, which is to manage spend, to protect our organizations from risk, and to support operations. So those are the components, the essential, the critical components of a threefold mandate of the procurement function, which should govern all of our activities and underpin all of our activities in our day-to-day function. So a good procurement strategy or savings strategy should be aligned to all those three parameters. Now, it is very easy for one to focus on the part of the mandate that refers to managing spend, but a good savings strategy would also look at all the elements that drive all the risk drivers in an organization and all of the ways in which the procurement function per se can impact in a negative way the support of operations. And if we look at our procurement systems and our day-to-day activities, we would see that there's savings opportunities in all three of those dimensions. So again, the 7 components of a good savings strategy you should have: 1, a thorough spend analysis, because an understanding of our spend and what our basket of goods, so to say, means to a supplier, it gives us leverage. So if we have $5 million worth of spend across different categories that are clearly defined, or we have $10 million worth of spend. The $10 million worth of spend would be worth more to, obviously, to a supplier than the $5 million worth of spend. And it also directly relates to what the supplier's core strengths are and how that profile, that spend profile, is broken out. So this gives us thorough leverage to have a complete spend analysis, and from that to strategically set our targets that are aligned with our organizational situation. So it is imperative, it is absolutely necessary that we understand and we do a thorough situational analysis from the economic, the fiscal parameters that affect organizations, from the competitive forces that drive cost pressures and other pressures in the industry, and to understand how our current political landscape and socio-demographic landscape and even the technological elements, how those affect our organization and how it would trigger certain spend patterns. So to set targets relative to our organizational situation analysis is very, very, very important. It's a very good strategic move. And then we would have to articulate and define how we could execute quick win opportunities to build credibility early on in our year-to-year and day-to-day activities, and build credibility and momentum 4 would be supplier relationships, opportunities execution. 5, our strategic sourcing opportunities execution. Our savings documentation and reporting is very important that we have a thorough understanding and a thorough, well-defined, thought-out process for how we document and report and dashboard our savings. And of course, 7, continuous improvement. Continuous improvement across the board in how we execute our day-to-day functions. If possible, I recommend we go upstream and we see how we could help our suppliers improve their processes. And then further downstream, we go to our customers, the organization's customers, to see what degree of process improvement and continuous improvement could be embarked in that arena, as it would impact supply and demand dynamics. So continuous improvement across the board, looking internally into our procurement function, how we execute our day-to-day processes, our conversion processes or manufacturing processes, our logistics function, again, further downstream to our customers, and then upstream to our suppliers. So looking for continuous improvement opportunities that we could reduce cost and reduce the total cost of ownership in the supply chain, in the entire value chain. Very, very, very important. So with that said, it is very important that we understand this very, very, very simple dynamic, the dynamic of profit and value creation, and to understand that organizations exist to create what? Organizations exist to create value for customers and stakeholders. And one very powerful indicator of value creation is profit. So essentially, people are in business to make profit. So this is the mindset of the average CEO and the CFO. They spend their energies and their time strategically to figure out how they could maximize profits. So to understand their situation, to understand the CEO and the CFO mindset, and to align our procurement functions with those mindsets and the mandates of the CEO and the CFO, it's very, very important. And profit could only be realized where revenues exceed expenses. And there's a matter of a deeper understanding of profit in which some of the finance experts refer to the best form of looking at profit as economic profit, in which the cost of capital and the cost of money is factored into the revenue minus expense equations. So I urge you to do some research on the concept of economic profit and how it relates to business in general and how it would relate to your procurement function. That could be a topic in our next Finance for Strategic Procurement webinar 2. I'll go a little deeper into economic profit and the concept. So it is very important that we're able to speak the language or accounting language. We could speak the language of the CEO and the CFO, and we could interact with and align our thought processes with the thought processes of these executives, the CEO and the CFO. And we understand the necessary terminology and the documentations and the ratios that are used and leverage the most important ratios, or the ratios that the CEOs and the CFOs and the senior level executives see as critical and important to how organizations operate, and to look at the basic and fundamental units of measure and how they impact our procurement function. On to the next slide. There in the finance webinar, we focused on 3 critical statements: the income statement, the balance sheet, and the cash flow statement. And it's very important as procurement professionals that as we as we formulate and we articulate and we execute our saving strategies, that our saving strategies are underpinned or integrated into the dynamics of our income statement, of our balance sheet, and our cash flow statement. So in other words, our activities and our initiatives to save money should be carefully integrated, and we should understand how our initiatives would affect these three critical statements. In terms of cash flow, as the saying goes, cash is king or cash is queen. And this is a very, very, very important statement, and it's a very, very important document, because a P&L or an income statement, a company could appear to be profitable and still have cash flow issues or negative cash flow situation. And the cash flow statement articulates the inflows of cash into your organizational environment or your organizational or economic or fiscal platform, and the outflows of your fiscal platform. And if there are more outflows than inflows, then there's a negative cash flow situation, and this could create severe problems and very, very disruptive to how your organization operates, and could be very, very disruptive to your supply chain and your ability to acquire goods and services at the right price points and to convert them and to ship them to your end users. So to have a positive cash flow it's critical in business, regardless of how profitable your organizations look on paper. So with that said, to be able to integrate our work and our saving strategies, where we look and we understand the degree of sensitivity, I would say, of each initiative, each savings initiative, and how it would affect these statements in real time, it is very, very important, because we are going to be scorecarded and judged by how our activities impact the income statement, balance sheet, and the cash flow statements. And believe me, our activities will. If we just focus on spend, and to, of course, support operations, and we don't manage the spend, then our income statement and our cash flow statements will be severely impacted. So with that said, I just want to go over the income statement for the service industry relative to the manufacturing environment, just to have a basic understanding of some of the critical nuances and differences between the two statements. So if we look at this example here, we see that revenues are $10,558,000. And we look at the expenses against those revenues: electric and fuel, purchased electric capacity, purchased gas, net, liquids, pipeline capacity, and other purchases. So in this, in the service side, we have our revenues, and we have the line item expenditures that go against those revenues. And then we would apply taxes, etc. And we would see, we'd have the total cost, and then from there we would have, we apply the taxes, and then we have the net income. So pretty much straightforward in terms of how the expenditures are driven against the top line revenues. But when we look at the typical manufacturing income statement example, we see a difference. So we see sales, and there's a component, the cost of goods sold, and then we would have gross profit. And then from the gross profit, we have the other expenditures, including interest expense and tax expense. And from there, you derive the net income or the net profit or the net loss. So if, for example, and again, I come from the bakery environment, the cost of goods sold, if a bakery is selling just solely, let's say, bread, it would be the cost of raw materials, the cost of packaging. These would be the labor costs. These would be the formulation for the cost of goods sold, and then so the revenues minus the cost of goods sold would be our gross profit, and then we would have the other expenditures or indirect expenditures that go against the gross profit, and then from there we would have our net income. So clear difference between the two types of income statements. And again, to understand how our saving strategies impact these income statements, it's very, 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 very important that we have that understanding and we could see the information real time, and all of our saving strategies, matrices are integrated with the income statement. Now, it is very important that we are able to integrate and to leverage our saving strategy against some very critical parameters. Of course, the total cost of ownership, the cost of poor quality, the cost of savings reporting, and our cash flow position. And I urge you to do some research on lean accounting methodologies versus traditional accounting methodologies. Because, for example, lean is a methodology that has been heavily leveraged by Toyota, for example, and it focuses on waging ongoing war, I would say, on wasteful activities or non-value-added activities in your environments, whether it be a service environment or a manufacturing environment. And the lean income statements look significantly different from the traditional accounting statements, or the income statement in particular, where you would see in the lean accounting methodology, you would see as a line item the cost of poor quality. And the cost of poor quality could relate to the cost of all of the waste elements in your environment, the cost of generating defects, the cost of overproduction, the cost of excessive inventories, carrying costs, etc., the cost of overprocessing, the cost of delays, the cost of or the underutilization of skill sets. All of these are clearly identified and quantified and are part of the financial statement. So it's very important that we understand these critical parameters. Now, we're going to go through some definitions here. And the first definition we're going to go over, some savings definitions, is how it is very important that we are able to articulate to our financial executives and to our CEO how we derive our savings. It is very important that we have clear formulas, and I would say operational definitions on how we define our savings and how which would be the output of our saving strategy. So it's very, very important that we have an understanding in your organization about these formulas. If we don't, they would be challenged. So the last thing we want to do is to go to a CFO and say, well, we save this and that amount, and then the CFO comes back and said, nope, I don't think so. We have a different understanding. Now, this would lead to some levels of conflict and politics that we don't want to. It's not advantageous for us to get into. So it's very, very important that there's an agreement and a clear understanding of our saving structure and how we define savings. So one type of saving is what we call the year-over-year or the year-on-year savings, which would be the old price that we would have paid for a product or service minus the new price for that product or service times the quantity purchased over a year. So the old price, and let's say the old price we were paying was, let's say, $1 for a product, and now we're paying 80 cents. And let's say we purchased 1 million units. So it would be the savings for that period would be the old price, $1, minus the new price, 80 cents. So 20 cents per unit times $1 million. Whatever that amount is equal to should be $200,000. So this is how we would calculate the year-on-year savings. And it's very important, and what you see on the screen, that formula and that definition is very, very important, that we have strategic alignment and understanding and agreement with those formulas. Then it is very important that we're able to, and we understand our payment terms and how our payment terms would impact our ability to save money for organizations and to reduce cost. So our payment terms, be it net 15 or net 14, net 30, net 60, net 90, it's very important that we strike a balance and have an understanding of our outflows relative to our accounts payable and our inflows relative to our accounts receivable, right? And these two parameters would impact the balance sheet dynamics and the balance sheet parameters, and of course the cash flow statement once those assets or liabilities are liquidated. So it's very, very important we understand these dynamics, and there's some degree of balance. So if our accounts receivable, net accounts receivable, or if you look at the ratio of receivables in days relative to net payables in days, that there is some balance. If you could somehow, of course, if you could have be able to pay, let's say, our suppliers in 60 days, so you have an outflow of cash going out every 60 days, and we receive our payments in 30 days, then you would have a favorable cash flow. But we have to guard against putting undue stress and fiscal stress on our suppliers, because over time, what would happen is that they would have no choice. They would either cut corners, give you lower grade product or service, or increase their price. So we have to understand our suppliers, their ability, the elasticity to be able to handle degrees of fiscal pressure, and we don't want to push them to the maximum pressure points, because there would be a reaction again in either lower grade product, lower grade service, diminished responsiveness, or an increase in price. So if they're a company organization that they're highly responsive, they care about their quality, then the next option is to either increase the price or leverage savings process improvement, continuous improvement, savings to reduce cost, to be able to lend you extended degrees of credit. So it's very, very important. Again, this goes into the initial conversation that we had about understanding our organizational situation and understanding our organizational environment and understanding our customers and understanding the situation of our suppliers. So to conduct continuous audits into our supplier situation is a very, very important and critical mechanism, and this should be our ongoing process. And my advice is do not put our suppliers under undue stress. So to strike that balance in terms of balance of payments and assuring that our payment terms put us in a favorable cash flow, and our suppliers also have a favorable cash flow, as they would have other customers, and the total, on average, they're in a situation where they're fiscally sound, fiscally viable, and they also have favorable cash flow. The more favorable their cash flow is, the better they will be at serving you and being a high caliber, top tier supplier. So it is very important that we understand the dynamics relative to payment terms, and to make savings on payment terms, that we're able to factor in the cost of money. And we see the formula here in order for us to realize savings on payment terms. Again, if we're able to pay our bills net 15, that's one matter. If we're able to pay those same bills in net 60, it will put us in there's savings there if we factor in the cost of money for those 45 days. If we have those revenues in those funds in our bank, they will be gaining benefit or interest, and that would be a form of savings. Again, we have to look at the total picture over a period of time, because those savings could be lost by our suppliers, or if we touch the supplier stress points, fiscal stress points, where again they cut quality or they raise their price. So that strategy, it's a double-edged sword. We have to be very, very, very careful how we try to realize savings as far as payment terms are concerned. Then there's substitution savings, right? So switching from either one supplier to the next, or from one product or service to the next, as long as the substitutions meet the customer requirements and specifications, then substitution savings would be the old price for a product or service minus the new price for a product or service times the quantity of the product or service purchased, right? Similar to the prior formula. With this, we have to be sure that the new product or service meets in a sustainable way the customer requirements. Because I've seen situations where procurement professionals would switch the product or service and for a different product or service, and they do not fully meet the customer requirements and specifications, and it creates cost and poor customer experience and returns and things of that nature. And so we end up, let's say we end up paying 20% reduction on the line item, on the product or service, but due to customer dissatisfaction, high defect rate, right? We end up losing money. So we have to be very, very, very careful, because this would impact the total cost of ownership equation, and it will impact our cash flow statement and our income statements. So we have to be very, very, very careful. Also, too, I've seen situations where suppliers were switched, or products were switched, or suppliers and products were switched, and the supply of the new product was not as reliable as the old product, or the new supplier who comes in with a slightly different product, even though it conforms to customer specifications, the supplier is not as reliable, right? So the supplier is not as reliable, not as responsive. Supplier comes in with late deliveries, high defect rate. So now it increases, or the defect rate increases your scrap rate. So all of those negatives have to be leveraged against your so-called savings. So a good CFO will say, yeah, you saved me $200,000 in your purchases. You got the price reduced, let's say by $200,000, but we had $500,000 worth of rework cost because of defects. We had another $100,000 delay cost of delays because the new supplier with the new product was late on several occasions. That created delays at the conversion process or the manufacturing process. We had people on overtime. That was another $100,000. So now, what is the net savings in that scenario? Negative $400,000. So we have to be very, very, very careful how we list savings, that we do a thorough job and we understand all of the parameters that drive the total cost of ownership metric. So if you're going to look for substitutions, we have to make sure that we have a high confidence level that those substitutions would, on a consistent basis, meet customer requirements and would not deliver unintended cost drivers or unintended consequences. As far as the matter of understanding ratios and and this was the focal point of the first webinar. The next webinar, we're going to dissect all of the saving strategy parameters and dynamics. But I just wanted to, in this webinar, to make us aware of the big picture and how important it is to be able to define what we mean by savings, and we understand the formulas, and we understand that it's imperative, it's absolutely necessary that we're able to define and articulate those formulas with the people that are going to use them against us, or they're going to use them to scorecard us. So it's very important that we as procurement professionals, we are aligned with our CEOs, we are aligned with our finance departments, we are aligned with our CFOs, we are aligned with our vice presidents and directors of finance in terms of how they view savings. That we're reading from the same book, and the formulas that we're using to book and list our savings are beyond reproach. And it will be very wise that we understand how our saving strategy would affect or impact the ratios, the critical ratios in our organization. things like the current ratio, the quick ratio, inventory turnover, accounts receivables turnover, accounts payable turnover, days in receivables, and as far as us procuring product and services from our suppliers as procurement professionals, our days in payables ratio, and how those affect our return on assets, our earnings per share, and our price to earnings ratio. And your organization, that as procurement professionals, you understand how our activities will affect our Altman Z-score, which dictates or which calculates the ability of our organizations to stay afloat. And if we're in some type of fiscal detriment, the number of days in which our organizations would exist. So this is the underpinning of the Altman Z-score, very, very important score. If we're doing the best that we can to control and to manage our spend, support our organizations effectively by procuring and acquiring competent and effective suppliers who deliver high-quality inputs, high-quality, low-cost or reasonably cost inputs into our conversion processes, which would yield high-quality outputs, which would yield a great customer experience. If we're executing those functions well, we're managing the spend, we're supporting our organizations and conversion processes effectively, and we're protecting organizations from risk, be there fiscal risk, physical risk, supply chain risk. If we're doing those effectively, then the Altman Z-score in our organizations would be positive. Organizations would be in a positive light. So if you understand these ratios and we're able to integrate some of these critical ratios into our saving strategy matrices, I think it would be to our advantage. So this way we can understand the sensitivity of our activities and how it impacts these ratios in either a positive or negative way. Also, as I mentioned before, to be able to integrate our saving strategy, our matrices, our spend analysis, our spend profiles, to integrate those, our savings matrices, if we're able to integrate those directly with your organization's income statements, cash flow statements, and balance sheet. So this way we could see our activities, how they affect our organization's fiscal situation, and we understand how the degree of sensitivity of our activities with those parameters. This would give us a very, very integrated, holistic alignment with our organization, and I would say non-siloed. We're not just the people who procure and spend money, right? The folks that are necessary, as I say, the necessary evil. So we're able to look and understand the integration, and it's very important if you could work with your IT departments to bridge and integrate the fiscal dashboards with the procurement dashboards. So this way we could understand, and we could understand how our activities impact our financial statements in real time. And we would perform diagnostics, and we would look for opportunities to improve, and we would look for areas where they're positive and we could leverage and capitalize on those dimensions. So that is our first of our 4-part webinar in terms of our savings strategy development, and it starts with understanding our organizational situation. It starts with aligning with our CEOs and our CFOs. It starts with being able to articulate our position and ourselves with a clear understanding of how they think, understand how they think, and to be able to drive organizations in the right direction, to be able to manage spend, support operations, and to reduce risk, and to understand and realize our core mandate. So I look forward to seeing you in our next webinar, part 2, where we will pick up and we start with the elements of the strategy and how our saving strategy would be executed. I hope you enjoyed today's webinar. Thank you for attending, and I hope you had an awesome experience. Have a great day.